Ladies and gentlemen, Greg Michalowski from ForexLive.com. Now it's time to take a look at the technicals that are driving the markets and that will drive the market in the early part of this week. What are the biases? What are the risks? What have we seen last week that may have changed that bias? We'll go through it all. We'll start with the euro versus US dollar. And looking at the daily chart here, what we saw in trading last week was the price continue its move to the upside that we saw in the prior weeks. It took the price all the way up through here. And in trading last week, we saw the extension up to and through this green line. This green line represents the 200-day moving average. And on Tuesday's trade, the price moved above that 200-day moving average. And we found buyers into that move to the upside. We'll take a look at the hourly chart a little later, but then the market rotated back to the downside. We failed above that level, and we rotated back down. In trading on Wednesday, the price again moved above the 200-day moving average. You can see it just a little bit right here and failed again. And on Thursday and Friday, we stayed below that moving average. So had enough of trying to get above the 200-day moving average and started to rotate back to the downside. The significance of the 200-day moving average, you'd expect that if on a break, it would go higher. Because the price last traded above the 200-day moving average way back here in June 16th of 2021. So a long time since the price moved above that moving average, and it couldn't stay above it this week. So that's a little bit problematic going into the new trading week. In the new trading week, we're going to need to get above that 200-day moving average, which is getting easier to get above because it is moving lower. It's a 1.0412. We need to get above that level in order to push the price back to the upside. There is other levels here on the daily chart which are also somewhat equally as important. I point out this swing area that between the 1.0348 and 1.0365 level. We've gone through this a number of different times over the last few weeks of trading, how that level is so important back through here as a floor area. We broke below that level and then retraced right to the area right here and found sellers down to our low price. In trading over the last week or so, the price moved back up to that area right here and found sellers, keeping the lid on the pair, and then rotated back to the upside on Tuesday, breaking above that level and above the 200-day moving average in the process. So this area right through here, this yellow area right here is going to be a key level, and you can see we close below that level again on Friday. And then we go down to this swing area through here. And this on the daily chart is also full of different levels where the market found sellers in this area through here a number of different times. And we try to move above it here and stay above it and move up to that top level. And then in trading this week, the market came down, and after we broke above it, we tested it and based against that level. So that level is also a key level. It also corresponds with the 38.2% retracement of the move down from the high price of 2022 to the low price of 2022. So number of different reasons there. So we can basically stand this chart here in the daily chart and analyze the key levels that are in play for the current trading week. 200-day moving average at 104.125, swing level 103.48 to 103.65, and the swing level between 102.73 and 102.93 with the 38.2% retracement in between that level at 102.84. Those are the levels that if we break below this level, it'll be more bearish. If we break above this level, it'll be more bullish, but we need to get above the 200 and so on and so forth. So that is how this area is playing out on the daily chart. If we take a look at the hourly chart, this is the 38.2% retracement of the move up. The last leg move higher in the pair, that level comes in at 102.72. Rising toward that is the 200-hour moving average of 102.62 currently. So that's going to be moving up toward that 38.2% retracement. The level also corresponds with this low through here. So this area that I have earmarked here as a yellow area, inclusive of the 38.2% retracement, is going to be a key level that needs to get broken on the downside and move below that level to increase the bearish bias. So let's see, 102.72. If we go to our daily chart here, and we look at 102.72, that would be right around the low of this swing area through here. So corresponds with that level right through there. So just be aware of how important that level is. Not only is it the 38.2% on the daily chart, but it's also a different 38.2% retracement on the hourly chart. So write that down on your notepad. Key level for the euro versus US dollar. Let's take a look at the dollar versus yen next. And we'll start off by taking a look at the daily chart. And what is significant here in trading this week is that we can count 1, 2, 3, 4, 5, and every day this week the market traded below the 100-day moving average. Number different times the market came up toward that level and rotated to the downside. First, the other thing that you can notice here is that it was a consolidation week. We've moved sharply to the downside over the last month or so of trading, and this week we saw the just consolidation after trading down to a low and a new low going back to this day right through here. But the momentum could not take the price to the 38.2% retracement of the 2022 trading range. This is a low from 2022. This is a high from 2022. Obviously, a big, huge trading trend to the upside here in the dollar versus yen. But the 38.2% retracement could not be broken in trading this last week. That level comes in at 137.70 or 24, and it would need to be broken on the downside in order to increase the bearish bias here for the dollar versus yen. So keep that level in mind in the new trading week. Mark it on your calendars. On the top side, what is important? Of course, the 100-day moving average is important here. We moved up toward it a number of different times this trading week and found early sellers against that level. So they're trying to keep a lid on that pair. If the price can stay below that level, we have the potential to move toward the 38.2, get below that level. Then we're starting to look at the rising 200-day moving average way down here, 133.37. Also, the 50% retracement of the 2022 trading range comes in at 132.70. But we need to stay below the 100. We need to get below 38.2% in order to have that happen. Taking a look at the hourly chart, what we see here is the consolidation that we saw in trading this week. That's obvious right here. This is our low price. Remember, it fell short of the 38.2% retracement. In Friday's trade, what do? We tried to hold. The buyers are trying to make a play here by holding against the 100 or near the 100-hour moving average, 139.77. So close support in the new trading week is going to be at that level. On the top side, we have that 100-day moving average that is key, and then the falling 200-hour moving average is also going to be key if the price is able to hold this 100, get above the 100-day moving average, and move above the 200-hour moving average, and that opens up the door for the upside with the 50% retracement at 142.157. So that's how I see the dollar versus yen. Next, let's look at the sterling versus US dollar. And if we bring up the daily chart of that, this is what that looks like in trading here this week. Again, a new high that was reached on Tuesday. That high price fell short of the 50% retracement of the 2022 trading range. There's a pattern here. Lots of trending markets in 2022 and lots of corrections over the last month or so of trading came up, whereas the dollar versus yen were fighting to get above the 38.2. In this currency pair, we moved above that 38.2 in trading last week and also above the 100-day moving average at around the same time here. So that increased the bullish bias, and we saw that momentum continue again into Tuesday, but fell short of the 50% retracement of the move down from the high to the low at 120.50 level. So keep that level in mind. We're back down at 118.40, but that 120.50 level is a key target that well held. So you got to give the benefit of the doubt a little to the sellers that they're leaning against that level. But if we were able to push back to the upside, that would be a level to get to and through, key level for going forward. On the downside, this yellow area here where we have outline again the number of different swing lows that came through here, got a little messy through here, and then use that level as resistance. And in trading here, just on last Thursday, the market came down to that level. So its importance was really more back through here. And if we break below that level, 117.59, I would be looking toward the 100-day moving average on the downside, which again we broke here in trading, not the past week, but the prior week. So that's and the 38.2% retracement is also at that same level for that currency pair. So be aware and prepared for that. On the hourly chart, the 100-hour moving average is close support. That'll be a key barometer in early trading this week. If the price is able to get below that level, we'd look toward the 38.2% retracement of this the trend move through here that took the price from this low around the 113 level up to the 120. So that's about 800 or 700, 800 pips. Pretty decent move to the upside. We're consolidating through here. If we break below the 100-hour moving average, again, we're going to start to look toward the 38.2% retracement, which is what held support in trading on Thursday. So, and the 200-hour moving average is starting to move up through there as well. So getting below that level will increase the bearish bias for the sterling versus US dollar. Let's take a look at the dollar versus Swiss franc next. And this currency pair is unlike the other three currency pairs that we looked so far, in that in those other currency pairs we saw a obvious trend move to the upside and then a corrective move over the last month and a half of trading, maybe just a month. But in the dollar versus Swiss, what do we see in this currency pair? For most of the trading year through here, lots of just ups and downs and ups and downs. It's like you're on a boat and you're getting seasick. But there are still some technical patterns in play here, which make it somewhat significant or easy to follow, I think. And if we go to the high prices here, for instance, we had two different highs right here, and so this was the end of a big leg to the upside here, and we completed that lap, if you will, from the low to the high, from the high to the low in trading here this week when the price bottomed. Fell below this level that was the August low near the 93.66 level, moved down to a low of 93.53 or 54. Maybe it was a little bit higher than that 65 level, I guess. But the price, you see the point. There's a number of different levels through here where the market came down to and through, and the market bounced off that level on Wednesday, Thursday, Friday, moved higher, and broke back above this trend line as well, which is somewhat significant on the daily chart. This trend line had started through here, point here, sort of a point there, point there, point there, point there, close to the point there, and we tried to stay below that level during the week this week, but then could not stay below that level. Started to move back above it. And it corresponds, the trend line, the break back above the trend line corresponds with this swing area through here as well. So that's going to be an area to watch on the downside. If the market should rotate down, look for support there if the buyers are going to take control and start to look up toward the 200-day moving average 50% retracement. Markets get used to these ups and downs moves, and they see a sharp move to the downside, which was like 8 days moving a huge amount. And instead of just correcting higher, they have been reversing the other way. But nevertheless, there is hurdles to get to and through on the top side. So if we do find ourselves moving up toward the 200-day moving average, I would look for sellers against that level. Why? Because we did find buyers against it here. So and then we broke through it here. So I would expect to see sellers against the 200, also against a 50% retracement of the year's trading range. That's how I look at the dollar versus Swiss in trading this week. All right, let's on the downside again, get below this broken trend line and below this yellow area, and maybe we don't have the snapback rally that we saw in other times for this currency pair. Take a look at the dollar versus Canada next. What do we see significance here on the daily chart? And what I see is a number of different lows against the blue line, rising blue line here, which is the 100-day moving average. Also near that level is a 38.2% retracement. Also near that levels are these swing levels through here. So you can see why there is good support down here at the lows, at the 100, at the 38.2, at the swing level. And the market did see a nice rebound to the top side. Now, when the dollar Canada goes higher, the Canadian dollar goes lower, and we saw oil prices this week move down like 10%. and that tends to weaken the Canadian dollar, but we only saw this little move to the upside here. So there is a bit of a concern that maybe the sellers are more in control here in this currency pair. But we have, as clues, a nice little swing area through here where we can define our risk and limit our risk and define our bias as well. In this area through here between 133.89 and 134.19. If we move above that level, then more bullishness for the dollar versus Canada. If we're able to stay below that level, then the selling pressure may continue for this currency pair. Below the, but we need to get below the 100-day moving average. Need to get below the 38.2% retracement. Need to get below this level near the 132. I guess that's 07 on the downside. Get through 132 even. That would increase the bearish bias for the dollar Canada. But right now we're trying to build higher and get above the 134-ish area and this swing area in that currency pair. Let's take a look at the Aussie versus US dollar next on the daily chart. And what we see on the daily chart is a failed move above the 100-day moving average. Now, this was similar, if you will, to the last time the market broke above the 100-day moving average. Back here, we had two closes above it, and then fell back and closed below it. In this instance, we had a number of days where the market traded above and below that blue line. Similar to here, we had, I guess, 1, 2, 3, 4 days of here. Here we had 1, 2, 3, 4, 5 days. All days last week traded above and below the 100-day moving average. But we only had 1, 2 closes above it. We closed below the 100-day moving average on Thursday, and we closed below it again on Friday, although we traded back above it and below it. So, it's still a key barometer, but the market is saying, I'm not so sure what we want to do. Do we want to go higher? Or do we want to go lower in this pair? And so that 100-day moving average is going to be a barometer in the new trading week. On the downside, this little swing area right below the 100-day moving average, as you can see, we went down toward the low of it on Friday's trade, but could not break below it. So if we get below that level at 0.66, I guess that's like 5.7. That would increase the bearish bias for the Aussie versus US dollar. On the hourly chart, that 5.7 level is within 16 pips of the rising 200-hour moving average. So keep the 100-hour moving or the hourly chart in mind as well. If we break below that 100-hour moving average, that would increase the bearish bias, and we look down toward the 38.2% retracement of this move somewhere around the 0.6598. So watch the 200-hour moving average in the short term here for the Aussie for clues as well. 100-day moving average, 100-hour moving average, 200-hour moving average, all in play here. We saw the 100-day moving average see price action above and below it all during the week last week. Finally, let's take a look at the New Zealand versus US dollar. And what we see in this currency pair is last week, toward the end of the week, we broke and closed above the 100-day moving average. And every day this week, the price stayed above that level. I'm happy to say for the bulls that the low price for the week also was able to stay above this swing level near the 0.6656 level, corresponded with this low going back to the month of July. Swing low that saw the price move above it, traded above and below that level, and trading here, and then moved above it in trading last week. And not only do we find support against it in Thursday's trade, but we also found support against it in Monday's trade. So that's going to be a barometer on the downside, 0.6656 level. Currently trading at 61.51, about 100 pips away from it. But that would be a target on the downside. On the top side, this swing area through here, where we have a number of different swing lows and swing highs through here as well, and then swing lows through here. These are just all key levels. Got a little messy there, but then reestablished the level here in trading this week. Market found sellers within that area between 0.6184 and 0.6212. Above that level, we have the 200 and the 38.2% retracement as a targets here for the New Zealand versus US dollar. Buyers are trying to make a play, but they do have resistance above the we are above the 100-day moving average. Need to get above the 200. Need to get above the swing area and watch this level here at the 0.6659 level, and you might be rewarded. So there you have it, a look at all the major currency pairs as we head into the new trading week. I hope you found this report useful as you gather up all your information and look to trade successfully in the trading week. So good fortune to trading. My name is Greg Michalowski. Bye-bye now.